Good morning children. I welcome you all to the next video of class 11th accountancy. We are going to start with the 5th chapter, that is accounting standards. First of all, we are going to talk about need for accounting standards. Why is there need for accounting standards? Accounting is an information system and its main aim is to provide financial information to a number of parties, such as investors, management, creditors and government, etc. Such information is provided through a set of financial statements, namely profit and loss account and balance sheet. As per the section 129 of the Companies Act 2013, the financial statements of the enterprise should depict a true and fair view of its operating result and financial position. However, what constitutes true and fair view has not been defined either in Companies Act 2013 or in any other statute. Over a period of time, a number of generally accepted accounting principles, they are also known as GAAP, in the form of concepts and conventions have been developed and accepted to bring comparability and uniformity in the financial statements of various business entities. So basically, what are accounting standards? It may be defined as a written statement issued from time to time by institutions of accounting professions, specifying uniform rules or practices for drawing the financial statements. Basically, they are a code of conduct imposed on accountants by customs, law or professional bodies. Okay. Now we are going to talk about the nature of accounting standards. So, first is accounting standards lay down the norms of accounting policies and practices by way of code to direct as how the transactions and events should be dealt with in accounts and disclosed in the financial statements. For example, accounting standards may define the term cost and lay down a definite method for valuation of inventories with minor modifications under special circumstances. Okay. Then second is in the way they remove the effect of diverse accounting practices and policies so that financial statements of different business units become comparable. Okay. Then third, they prescribe a preferred accounting treatment from the available set of methods for solving one or more accounting problems. Then they provide information to the users of financial statements as to the basis on which such statements have been prepared. Then they limit the area within which accountant has to function, and in this respect they are just like laws. However, accounting standards do not aim to introduce rigidity in accounting. They only attempt to limit the flexibility and provide the accountants realistic guidelines. Okay. Then we move ahead to objectives of accounting standards. These AS means accounting standards. So first is to ensure uniformity in the preparation and presentation of financial statements. Okay. Then second is to provide information to the users about the policies adopted in the preparation of financial statements. Then third, to remove the effect of diverse accounting policies and practices. Then to ensure consistency, transparency and comparability of financial statements. Then next, to improve the reliability and credibility of financial statements. Okay. Then we move on to the utility or benefits of accounting standards. So accounting standards have been evolved to curb the abuse of flexibility in the adoption of accounting policies by the business enterprises. So accounting standards provides the accountants those accounting policies which are most suitable in a given situation. So first we are going to talk about accounting standards improves the reliability and creditability of financial statements. What is that? There are numerous parties which are interested in the accounting information. So they include investors, management, creditors, employees, government officials and researchers. It is therefore necessary that the financial statements present a true and fair value of the financial position and opening result of the enterprise. So accounting standards generate confidence among the users of the accounting information by providing a definite structure of uniform guidelines which helps the reliability and credibility of the accounting information. Then second is accounting standards ensures the consistency and comparability of financial statements. Accounting standards make the financial statements of the different parties or of the same enterprise for different accounting periods comparable. They bring the uniformity of assumptions and rules and policies adopted in the preparation of financial statements, and thus they ensure the consistency and comparability of such statements, which in turn ensures better comparison of profitability, financial position and future prospects of the enterprise. In the absence of accounting standards, comparison of different financial statements may lead to wrong conclusions because each enterprise would evolve its own rules or standards to suit its purpose. Then next is accounting standards help in resolving the conflicts of financial interest among various groups. Sometimes there is a conflict of financial interest among the various groups interested in financial statements. For example, shareholders and creditors may have opposite interest in ascertaining the profitability and net worth of the enterprise. So accounting standards are helpful in resolving such conflicts because financial statements draw upon the basis of accounting standards which are accepted to all the groups. Okay. Then next is accounting standards significantly reduces the chances of manipulations and frauds. How come? Adoption of accounting standards in the preparation of financial statements has reduced the chances of manipulation, frauds, insufficient disclosures or the use of inappropriate accounting policies. Then it is helpful to auditors also. It is the duty of auditors to ensure that the accounting standards have been followed in the preparation of financial statements. In case of deviation, it is also their duty to make adequate disclosure in their reports so that the users of such statements may be aware of such deviations. As a result, the auditors will be free from court cases and various penal provisions under the company's law in cases of inducted frauds or insufficient disclosures or due to adoption of inappropriate accounting policies. Then we move ahead to the limitations. In spite of many benefits derived, accounting standards have some limitation. First, it restricts initiative. That is, since accounting standards are mandatory in nature, they restrict initiative for better presentation and disclosure. Then next, rigid in nature. Accounting standards are rigid in nature. They restrain the accountants from using a more suitable alternative solution to a particular problem. Then it is based on historical cost. Accounting standards are based on historical cost concept. So assets are shown in the balance sheet at historical cost, and as such depreciation is also charged on such historical cost. So it is for this reason that the international financial reporting standards, that is IFRS, were introduced, wherein the assets and liabilities are required to be shown at current or fair value as at the date of balance sheet. Then last is obstruct the judgment of auditors also. How come? Accounting standard obstruct the judgment of auditors as the standards are mandatory. So today we are going to discuss up till here only. You prepare the notes regarding this. In the next video we are going to continue with the chapter. Up till then, goodbye children and take care.